Welcome back to the Noob Selling Options channel. Go ahead and drop a like and subscribe real quick because today we are diving into a highly strategic portfolio rotation. We're looking at a massive move that literally shifts how your capital works for you, all while keeping us totally anchored in high conviction AI growth. We're calling this the AI Fortress rotation. Let's just get right into it. So here's a quick roadmap for today's explainer. We'll start with a portfolio update and the big trade execution, then look at why we're locking in our Broadcom gains and buying the ServiceNow dip, and finally wrap up with how this all unlocks some serious double premium power. All right, kicking things off with sections 1 and 2, the portfolio update and the big trade execution. We always want total transparency here, so we're going to show you the literal receipts of this massive high conviction rotation. Boom, executed. As you can see, we completely cleared out our stranded position of 22.17 fractional shares of Broadcom, ticker AVGO, at $420.57. And then we instantly redeployed that exact capital, $9,329, to grab over 103 shares of ServiceNow, ticker NOW, at $90.27. You know, this isn't just some random shuffle. It's a calculated maneuver to seriously optimize our capital efficiency. Moving right along to section 3, locking in our Broadcom gains and the valuation rationale behind it. Let's talk about exactly why we walked away from Broadcom, because honestly, it's been an absolute beast of a stock for us. Just look at this number, 80x. There's a very clear macro valuation logic behind taking our profits right now. Broadcom has had this incredible run, right? Surging over 100% in the past year, thanks to that massive AI networking and VMware-driven rally. But because of that explosive growth, it's trading at a massive premium right now, boasting a P/E ratio of over 80x. Let's break down that why just a bit further. With that 80x PE, a lot of analysts are literally flagging Broadcom as overvalued at this point. We've got to remember that despite this massive AI build-out happening globally, semiconductor hardware can be a highly cyclical industry. So by stepping away now, we decided to lock in those impressive 100% gains before the natural volatility of cyclical hardware cycles could, eat into our profits. Basically, selling high secures the bag for us. Okay, section 4, buying the ServiceNow dip and the software advantage. So the absolute crucial next step was figuring out where to park that $9,329 to maximize our capital efficiency, but without abandoning the AI space. And we found our target with a textbook buy the dip opportunity. ServiceNow recently experienced a pretty sharp 13% pullback. Following their recent 5-for-1 split, the stock dropped from over $100 down into the low 90s. So we swooped in and snagged our shares at $90.27, catching it right in that optimal discount zone. But you're probably wondering, why did it drop? And more importantly, why are we buying? Well, this dip was primarily driven by macro concerns and a temporary margin dilution from their massive $7 billion acquisition of Armis Security. The stock was flashing technically oversold, but guys, their underlying business is an absolute juggernaut. Their core AI subscription revenues are scaling rapidly toward $1.5 billion. We are basically buying into high-margin, sticky, recurring enterprise software revenue at a really nice temporary discount. Let's just contrast these two approaches for a second. On one side, you have Broadcom, cyclical hardware, 100% surge, and a stretched 80x PE. So we sold the rip. On the other side, ServiceNow, recurring software, scaling revenues, and a 13% pullback. So we bought the dip. This completely shifts the balance of our portfolio from semiconductor hardware into high-margin enterprise AI software, kind of smoothing out our volatility while still keeping us fully exposed to the AI boom. All right, moving to section 5, unlocking double premium power. Let's see how this trade builds directly into the absolute core tactic of this channel, which is maximizing our capital efficiency to sell options. This is where the magic actually happens. At Broadcom's post-split price of around $430, our $9,000 only bought us about 20 fractional shares. And in the options world, 20 shares literally leaves you stranded on the sidelines. You need 100 shares to write a contract. But by swapping that capital into ServiceNow at $90, we suddenly have enough to buy over 100 shares. This puts the wheel strategy, our strategy of selling cash-secured puts and covered calls, right back into play immediately, so we can start writing covered calls for active income. And here is the kicker. Because of the shares we already held, with this latest execution of 103 additional shares, the AI Fortress portfolio now officially holds exactly
203 shares of ServiceNow.
Hitting that 203 share total is the ultimate unlock for us. It means we now control 2 full 100 share blocks of ServiceNow. We have instantly doubled our premium generation power. We can write 2 covered call contracts right out of the gate. This active income generation accelerates our compounding curve so dramatically as we march toward our long-term 2032 wealth milestone. We basically sacrificed a fractional stranded position to gain double the options leverage on a totally discounted SaaS leader. It's a total game changer. So let's recap. We've locked in our hardware gains, bought the software dip, and completely doubled our covered call capacity. It is a massive win for capital efficiency. Thank you so much for joining this explainer today. If you found this breakdown helpful, please hit that like button. Make sure you subscribe to the Noob Selling Options channel so you don't miss our next update, and drop a comment below. Seriously, I want to know, how are you navigating this market right now? What is your next big move? Think about it, and I'll see you in the next one.